Initially, okay, they want to buy XYZ company. Now, when you want to buy XYZ company, the intention is they should have control. How you will get control? You will get control only when you will buy more than 51% of equity shares. Only equity shares. Is that only? See, this lecture is basis for 18 and 19. Okay? This is 18. 18, 19 are calculations. Fine? 18, 19 are pure calculations. 17 is pure concepts. Now, you have to buy 51% of shares. Then only you will have control. The moment you are buying more than 51% of shares, immediately what will happen? This company, the APC company, will become a parent, whereas XYZ company will become a subsidiary. Initially, they have individual financial statement. ABC company will prepare financial statements separately. XYZ company prepares financial statements separately. Okay? Both will prepare separately. Now, the moment this deal has been done between the parent company and the subsidiary company, between two different companies, don't say like that, between two different companies, after the deal, this is going to be called as a parent company, this is going to be called as a subsidiary company. Parent company will purchase, understand what? Parent company, the ABC company will purchase. Is it? ABC company will purchase shares of XYZ. When you are purchasing the shares of XYZ company, is it? See the thing. Here the calculations will start. First and foremost, what happens? The first step is you have to calculate the percentage of shares. Because on this percentage of shares, what will happen? The entire structure will be based. You will have profits, you will have losses. Percentage shares of parent company P, percentage shares of S Limited, subsidiary. All the questions, wherever it's possible, we are using only P and S. Is it? P, by default, P is known as a parent company. By default, S is known as a subsidiary company. Parent company shares are, what is the stake? You have taken 70%, you have taken 80%, you have taken 20%. How much you have taken? Is it 50? More than 51%. More than 51%, 60, 70, 80, whatever it may be. The remaining balance will be for the subsidiary. Now, they will share the profits and losses based on the percentage of shares. Now, when you are purchasing the shares of a subsidiary XYZ, is it right? There will be some market value. Market value will be 110,000. Definitely, from this market value, we will deduct what? Book value. Assume that book value is 8,000. How much you are paying more? You are paying more how much? 2,000. This 2,000 is called as a good. Plus you will have lot of adjustments. I am not talking about those adjustments here. Is it right? Plus you will have lot of different adjustments, not different adjustments, in only the adjustments related to profits. That's all. The adjustments related to profits, these things, is it right? These things belongs to subsidiary. Means any calculation you are doing, got what? Any calculation you are doing, understand what? Any calculation you are doing the calculations for the subsidiary company only. You are not going to do any calculations for the parent company. Fine. Any calculation for subsidiary company. No calculations for the parent company. Fine. Ultimately, once we have done this, you will have all. What you will do? Initially, we will have two different balance sheets. In the end, we prepare one balance sheet. We say that it is a consolidated financial statements. Income statement will be one, balance sheet will be one. We are not talking anything about cash flow statement here. We are not talking anything. They will not ask you cash flow statement at all. They will only ask you what? They will only ask you the income statement. Is that? If they will ask you the balance sheet, statement of financial position. What we are doing in this process, we are making a consolidated. This process is called as principle of consolidated financial statements. Is it? This process is called as a principle of consolidated financial statements. Definitely. Is it? Percentage of shares, how much you have paid. Then subsequently we will have some adjustments. We will add, we will deduct, all those things will be there. And in the end, we will prepare one consolidation. Is it? This is the basic summary of this lecture. Not only the summary of this lecture, but summary of this 17, 18 and 19. In 18 we will do balance sheet. In 19 we do income statement. Is it? Consolidation. That's all. Is it? A simple basic mathematics. Understand what? More than accounting, I'm saying accounting is very less here. Accounting part is very less. Mathematical part, basic mathematics part is very more. Is it? Very high. Fine. This is what we are doing. Now, coming to the point. Upon the completion of lecture, very simple. This is the point where we have find. See, you have to introspect where we have went wrong, where we went right. When we do the multiple choice question, section A and section B, if what my observation says, sometimes I have said that no, this information is not important. Why I have to do this, give this information? But ultimately what happened? If you are not covering that information, we are not able to solve some specific problem. That is the reason yesterday we have stopped two problems. The reason behind that is we have not covered that part in the theoretical aspects. Theory is lecture. PowerPoint is very important. If you cover the complete concepts in PowerPoint, answering section A or section B or section C is very, very easy. Fine? No problem. Next time we will take all precautions. What it says that when we are talking about the IFRS, when we are talking about the consolidation, describe the first we have to what is the single economic unit. Describe the concept of a group. Group is nothing but more than one. Okay? Two companies. Now don't think about other things. Only two companies. What is the objective of consolidated financial statements? I told you, economics of scale, economics of scope, economics of experience. Definitely. What will happen? More importantly, we will say there is a synergy. Technical word, financial word. Is it? It is a financial. What is that? We call it as a synergy. There will be a lot of synergies will be there. Definitely. Is that one person is good in marketing, one person is good in advertising, I am good in production. Fine. We will have synergies. Is it right? Explain and apply the definition of subsidiary. What is a subsidiary? According to what? IFRS 10. Is it? Why IFRS 10 we are taking? You should ask. The reason is here more than accounting, we are concerned about what? we are concerned about reporting. Is it? More than accounting, we are concerned about reporting. That is the reason we are talking about IFRS 10. Identify circumstances in which group is required to prepare. What is the reasons why we prepare financial statements? Why directors may not wish to consolidate? Why? Explain why. Definitely, they don't wish. It is not a general statement. It is conditional statement. Okay, it is not applicable as a blanket rule to all. But fine. Sometimes director don't wish to consolidate because of you are diluting. Is it right? What is happening? The control will get. Is it right? The control will get diluted. List the circumstances where it is permitted not to consolidate. There are some conditions. Explain the need for continuous year ends. Is that means complicated? Is that uniform accounting policies while preparing consolidated financial statements? And such. The last but not the least, anything is eliminate intergroup transactions. What are intergroup transactions? I will highlight here only. You have ABC company, you have XYZ company. This is the parent, this is the subsidiary. Assume ABC has receivables of 10,000. These receivables are from where? XYZ. Now, if ABC is receivable from the XYZ, it means for the XYZ company, it is payables. One is receiving, one is paying. Now, once there is a consolidation, this is going to be identified as what? This is going to be identified as, This is going to be identified as intergroup transactions between the group once there is a acquisition take place. Is it? What we are doing? We will deduct 10,000 from the receivables. We deduct 10,000 from the payables. Ultimately, these two transactions will be cancelled. As simple as that. Debit against the credit. Asset is a debit, liability is a credit. What will happen? We are not going to show this transaction. Any common transactions. Understand what? Any common transaction. Basically, we are talking in terms of the payables and receivables. Sometimes, in some context, they will be purchase and sales. Is it? They will be purchase and sales. If that is the case, we will take into consideration the facts related to that. In the examination, in the question, they will mention very specifically. Is it? They mention very specifically what is the intergroup transactions. Fine? Slowly and steadily. Is it? See, today what is happening? Understand. Understand what? Listen. I will not say understand. Today what's happening? Listen. Okay? Tomorrow what's happening? Understand. Next, third class, what's happening? Make application. Okay? Don't say, expect that you will understand today only. No. Today we are only listening. Inshallah, tomorrow class we will understand. Third class, we will apply those things. Slowly, that is a migration that will take place. Okay? Now, this is what the group says. Is that when a group company is there principles of what are the principles of consolidation? Exclusion. What are the things we can exclude it? Is it right? And there is a single entity. When we are talking about a single entity, there is a subsidiary and there is a. If you put the things, definitely it is called as a group. Fine. What is it? Now you have complete understanding about what's happening. You don't need my support. Very simple. I am telling you this. You will understand point by point very easily. If one company is owned 50%, is it right? If one company owns 50% of the another company, of shares of another company, this will give them, the first company, what did happen? It will give them control. If the first company, parent company, has enough voting power, is it, to appoint all the directors, that's all, as simple as that. Of the second company, the second company is going to be called as a subsidiary. Now you will not use anything else. We will use a parent company P and a subsidiary company S. Parent company will have a control. Is it? Will have a control. Control in terms of shares, control in terms of directors, is it? Control in terms of running the operations. P, parent company, is able to manage subsidiary, and if it is merely a department of P, then it is called as a separate. If only one department, a separate entity, but you are managing the complete operations of a subsidiary, then you will call it as a parent company, and other company is going to be called as a subsidiary. In strict legal terms, P and S remain different, but in economic substance, they can be recorded as a group. Legal terms, is that legal terms means you are not losing your identity as a subsidiary company. Subsidiary company identity will be there, legal identity. Subsidiary company is always called as a ABC company. Is it? Subsidiary company is always called as a ABC. That entity, legal entity, will be there. Is it right? That's what we call it. The key principles of a group accounts. Here I have not mentioned, but if you see the textbook, there is one diagram like that. It says that this is the parent company and this is the subsidiary company. Both are individuals. Both are registered under as per the law. Parent company controls. That is the only matters, and that is the most important thing that matters. Parent company controls subsidiary company, and therefore they form a single entity. Then only it is going to be called as a group. Fine. Listen. Only listen. Very simple. See, I will tell you very clearly. Only listen what's happening. Tomorrow, the moment you take pen and calculator, you will understand how things will work. The purpose of consolidation, what is the reasons? You present one financial information about the parent company and subsidiary company as a single economic unit. I told you, again I am putting this. You have ABC company, you have XYZ company. Both are there. Understand point? Both will be there in picture. No way. Only thing is they are operating separately. Okay? They are operating separately. They have separate legal existence. Once this purchase is done, what will happen? They will not have a separate financial statements, but they will have a single financial statement. That process is called as consolidation. Preparing one financial statements from two individual financial statements. It's very interesting. You will enjoy, you will understand, and more importantly, you will score marks. Is it? Score marks. And if you are doing this strategic business reporting in professional level, we are having the next level of this group accounts. Okay? Show the economic resources controlled by the group. What are the obligations of the group? Payment structures. Show the results of group achieves with the resources. What are the results? Results is nothing but only one thing that matters in terms of profit and losses. Is it? In terms of profit and losses. IFRS 10, what it says? IFRS 10 says that it is a consolidated financial statement. Uses following definitions. There is a parent, an entity that controls one or more entity. You have the subsidiary, entity that is controlled by another entity. Control of the investee. An investor controls an investee when the investor is exposed or has the rights. How you are getting the rights? You are getting the rights through the purchase of shares. Is it? Involvement with the investee and the ability to affect those returns through power over the investee. How you will have power over the investee? Definitely. See, at the basic ground level, we say that what is the equity share equity share shareholders equity, or we say that what is the shareholders pattern. Is it? Shareholders pattern. That's all. Is it? That is the group. IFRS 10 outlines. Now you can measure, you can understand what we are talking about. Is it? IFRS 10 outlines the circumstances in which a group required to prepare consolidation. Consolidation statement should be prepared when the parent company has control over the subsidiary. What is the basic condition? The basic condition is you should have voting power, 50% or more. How the control is identified? That's very simple. There are three elements. Power over the investee in terms of shareholders, exposure of variable returns from its investments. Definitely, the moment variable returns from the investment says, it means that equity, because equity is the only one element where the returns will vary. Okay, if profits are more, dividends are more. If profits are less, dividends are less. The ability to use the power over the investee to affect the amount of investment. You have to use the power, is it right? How you can use the power? You can use the power through equity shares. Is it right? You can use the power. Is it right? You can use the power by what? By appointment of directors. Fine? Listen. These are the basic core points. Okay? Core points. Without doing this, we cannot go further. IFRS adopts principle-based approach. Rules. Okay? Principle means rules-based. Whether or not control is exercised in a given situation, which may require some exercise or judgment. One outcome is that it should lead or more consistent judgments being made with the consequence of greater comparability. Principle-based mechanism, principle-based approach. Is it right? Means what happens? You should have, see, what we have studied in accounting, there should be what? There should be consistency. When there is a consistency, then only there will be a comparison. Is it? Consistency is not there, comparison. That is what they say. They are talking about two things. One, they are talking about consistent judgments, and one, they are talking in terms of comparability. Of what? Financial reporting, information. If you have, if there is no consistency, we cannot compare. IFRS says that investors should periodically consider whether control of an investment has been gained or lost. Is that sometimes that's what happens? What happens whenever there is a shareholding pattern? Shareholding pattern will change. Somebody will buy, somebody will sell. You are having, assume you are having 30%. Maybe somebody will become 31%, or somebody will be 31%, they will become how much? 29%. Okay? That we have to consider every time. This we will not do that much here, but subsequently we will do. Okay? Not in this exam. Is it? But they have made it very clear. Exercise of majority of voting rights. It is more than 50% of the voting shares. Potential future voting rights such as share options or convertible loans. Again, you have to take financial assets and financial liabilities. In financial liabilities, you have the concept of what? Convertible loans. We have convertible bonds. This is the concept which we are going to carry forward from that lecture as such. Is it right? May result in the investor gaining or losing control on specific items. There are some exemptions why we can have the advantage. Okay? Of prepare. Why we can. What is the need if necessary that we can avoid preparing a group financials? A parent need not present consolidated statements if and only. Why? What is the reasons? Is that parent itself is a own subsidiary. Parent is a subsidiary. Is it right? See the thing. Now, till now what we have done, we said that this is the parent, this is the subsidiary. One-to-one relationship. Is that one-to-one relation? Assume parent, is that subsidiary? Is it? There is another company will be there who is holding 100%. Is it? Who is holding? Assume this is holding 70%. A company. The subsidiary company maintains how much? Make it 60. Okay. Make it 60. The subsidiary company maintains how much? 30. Sorry. The parent company, this is not going to be a parent, okay? In that case, what will happen? The structure will change. Is that? This will become a parent. Is that? This will become a parent, and this will become a subsidiary. Now, what is the second level? From here to here, how much is there? 10%. That's what it says. 60 plus 30, 90 plus 10. This will be a parent company, this will be a subsidiary company. The pattern will change, okay? The pattern will change, definitely the overheads will change. From our examination point of view, is it right? From our examination point of view, we are going to take from here to here only. Or, I will put it more easy way. Is it right? I will put it a more easy way. This is A and this is P. Okay? What I will put it in a more easy way. We are going to say that what? We are talking about only this. Where the parent, we are not, where the parent is going to be how much? Parent is going to be 70. And the subsidiary will be how much? 30. I am taking just an example what I think. But when you are taking this example, the precondition is it should be more than 51%. The parent itself is a own subsidiary. In this case, we are not supposed to prepare financial statements. Who will prepare financial statements? The financial statements is prepared by the parent company only. Parent company only. Subsidiary will never prepare a financial statement. Is it? In that case, we have the option to not to prepare financial statements. Is it? Parent debt and equity instruments are not traded in the market. Means definitely you are not a listed company. Is it? If you are not a listed company, you are not supposed to do this type of transactions. The parent do not file its financial statements with the Security Commission or regulatory for the purpose of issuing any class of instruments in the public market. Means you have not issued any financial instruments as such. Is it right? But maybe in future you will issue it. Is it? If that is the case, if it are not been issued, what happens in future? That's a different case. Is it right? Purpose of issuing any class of statement in the public market, that will think over it. But if it is not a listed company, do not file the financial statements. Is it right? We are not filing the financial statement. Definitely. If you have not registered, you are not supposed to. There is no implications, obligations. Is it right? More than implication, it is the obligation that we are not supposed to file the financial statement. Only listed companies have to do that. The ultimate parent company produces consolidated financial statements that are going to be in comply with which one? With the IFRS standards. When exemption, see, in that case, what will come? IAS 27 will come. Is it right? IAS 27 will come. IFRS 10, consolidations. IFRS 7, separate financial statements. Is it? Require the following. The fact that consolidated financial statements are not being presented, list of significant investments, percentage of shareholding, principal place of business and country of interpretations. Is it right? Means you should furnish this type of information. Then only it's practicable. The basis on which these investments listed above has been accounted in a separate fund. Means when you are making which type of investments, is it? Which type of investments? The investments has to be very, very specific. Is it right? If that is the case, then we have the option to prepare separate financials. When make it very clear. Is it? When we, in fact, that they are not preparing as a one unit, but they are working, they are collaborating. If that is the case, they are not supposed to consolidate it. Reasons for wanting to exclude a subsidiary. Definitely, why directors of the parent company may not wish to consolidate. See, whenever you consolidate, is it right? Whenever you consolidate, what will happen? What will happen? Is it right? You are taking a parent company will take over a subsidiary company. Is it? See, when the subsidiary company is good, when the subsidiary company is performing well, understand what? Subsidiary company will not get sold off. When subsidiary company is not performing well, subsidiary company in losses, that they think that it is better that the subsidiary company should be sold off. Means in extreme cases. Is it? In the extreme cases. Very specifically, in extreme cases, when a subsidiary is running in losses. When subsidiary is running in losses, if a parent company say take over it, what's happening? You have to absorb losses. Losses of whom? Losses of subsidiary. automatically. See, is that automatically? Parent company balance sheet is very healthy, very healthy. But the moment you are acquiring it, the parent company balance sheet will have some impact. Is it right? Nobody wants that my healthy balance sheet should be looked ugly. But things are very different here. People are there. Tomorrow you will do the same thing. You will be no different, nor I will be different. Everyone have the same approach. We will wish to take a poor performing company and we want to transform into a performing company. We buy a poor performing company at a lesser price and we sell, we consolidate and we increase the value of that company. When it comes and start working as a group. Directors of parent company may not wish to consolidate because it's a poor performance. Is it right? As simple as that. Poor performance of the subsidiary. Poor financial position. Is it not working well? Subsidiary, is it? It's not working well. Different activities of the subsidiary. It's an advantage. They will say that they don't want, but yes, the directors don't want because they want to again, if they assume, isn't it? If they assume they are in the construction business, they want to buy a information technology company. Both are different, is it right? Both are different. Both are rest from the group. Again, we have to map the things. We have to map in such a way that there should be a common understanding between a parent company and a subsidiary company. Fine. Now, that is the basic introduction about this. Okay. Now, I can say with some little confidence that you understand the concept of a parent company, the concept of a subsidiary company. I will complete this and I will stop little bit early. Okay? I will stop little bit early because tomorrow, inshallah, we will do lecture 18. Which of the following definitions is not included? Is it? Which of the following? See, the rule says that you should have power over the investee. You have the exposure to rights, variable returns. That is one of the preconditions. Is it right? Is it? Having the ability to use power. Is that? Have the majority of shares. In some cases, majority of shares will also be nullified. Is it right? Reverse integration. Having the ability to use what? Power. This is more specific. It does affect the amount of returns. Whenever you are talking about the things, you have to focus on returns. This is not part of the IFRS 10. Which of the following suggestions is likely to represent control over the investee? What the rule says, and very clearly, rule says that if you are having more than 51% owning, but the constitution requires that the decision need to be anonymous and or everybody has to agree. But if you have 51, there is no 55%, there is no 40% or so. It's only very clearly stated 51% only. Is it right? 51% only. Which of the following is not a condition? Is that not a condition which must be met for the parent to be exempt from producing consolidated financial statement? Just now we have covered, is that what the thing the activities of the subsidiary are significantly different to the rest of the world, rest of the group. And consolidate them would be prejudiced to the overall position. Both are different, is it right? Then we cannot have a consolidation also. Is it right? In that cases, it is not a condition. The ultimate parent company produces consolidations that comply with IFRS standards. The public parent debt equity instruments are not traded in the public market. Is it? The parent itself is a the parent itself is a wholly owned subsidiary. What the rule says? See the thing. Which of the following is not a condition? No. 1 minute. 1 minute. Parent need not present consolidated financial statements. Equity not traded, but not file financial statements. No. This is the condition. Is it? This is the condition. This is the condition. This is the condition. This is not a condition. Is it right? The parent itself is only wholly owned subsidiary or a partially owned subsidiary whose owners do not object. No, this point is not there. Is it? This point is not there. Fine. All three are the conditions. Activities of the subsidiary different. The ultimate parent produces consolidated financial statements. These are the conditions. The parent debt and equity are not traded in the public market. Which of the following statements regarding consolidated financial statements are true? For consolidations, all companies within the group must have the same year end. All companies, we have not covered this, is it right? That is the reason we have to cover each and every concept as such. I thought I have taken some important points, is it right? I have taken some important points, fine. I skipped 1 or 2 points, said that is the reason it is there in that, no problem, okay? Which of the following statements regarding consolidated financial statement is correct? There is no condition for consolidation. All companies within the group must have. There is no condition like that you should have one year end. Different year ends will be there. Is it right? All companies within the group must have the same accounting policy. No, you will have a different. What is the accounting policy? Assume in terms of depreciation. Is it? In terms of, somebody will use straight line method, somebody will use return on value method, somebody use years of digit method. Is it right? Years of digit method. Everyone will have their own way of working. Only 100% of subsidiaries. There is no 100%. Is it right? If it is going to be 100%, then it is going. The parent and subsidiary relationship will not be there. Is it right? Subsidiary relationship will not exist. Is it right? Will not exist. Is it? It means that for consolidation, it may be acceptable to use financial. Why of the first regarding is correct. For consolidation, it may be accepted to use financial statement of the subsidiary if the year end differs by 2 months. This is one. Is it right? I am writing here. I will explain again. Okay? Explain again. First I will explain the theoretical concept, then I will come back to this. Okay? Now you got a very specific understanding. What is the understanding? What is the parent company and what is the subsidiary company? That's all. I'm not talking about anything more than that. Okay? Nothing more than that. Just a basic principles of parent and subsidiary. Fine? We will do this, okay? We will do randomly. We will do randomly as much as possible, okay? One minute. We just I'm just searching. Is it right? Done. We'll do this. Okay? We'll do this. What is that? Advent company. Okay? Advent company. It is related to what? It is related to non-current assets. Okay, it is related to what? It is related to non-current assets. Fine. It is related to non-current assets. Disposal of land and buildings. Is it right? Depreciation charge. Depreciation charge. First 1 minute. Which it is non-current assets. Which one is that? Which chapter is that? This chapter 1 now. Chapter 2. Yes. Fine. It is non-current assets. Fine. What we have done in non-current assets is that very quick, very fast. Okay. We are talking about initial measurement, capital and revenue, depreciation. Is it right? Government grants and investment properties. Is it right? That's what we have done in non-current. Yes. First, we need, correct, we have done something which is worthy to work it out. Is it right? The time of recognition, tangible assets, how we have to calculate the total cost, one-time expenses. Is it right? And yes, what are the, we have to identify what is the capital expenditure and what is the revenue expenditure. We have to exclude revenue expenditure. Is it right? So any subsequent expenditure which will increase the efficiency of the asset, we have to add it. Is it right? Subsequent expenditure. And what is this? Depreciation. The straight line method, all those things. Is it right? Oh, once upon a time, it's a long time we have done this. Is it right? You are had overall cost. If it is increasing the value efficiency, it has to be capitalized. If it is not increasing the value of efficiency and the life of the asset, we should not capitalize it. Is it right? You have the cost model and revaluation model. Tangible assets. Fine. Good. Depreciation on revalued non-current assets. We have to take the current value on the current value. We have to calculate the depreciation. Is it right? Fine. Good. Where are we? BPP section B. Fine. Good. Can I start? Yes, wait, I'm drinking water. Is it right? What it says, the following scenario relates to fine. Is it? Advent is a public listed company. Details of non-current assets. Is it right? Land and buildings, plant, telecommunication license, total. Cost, accumulated depreciation and carrying amount. Okay? Cost, accumulated depreciation and the carrying amount. The land and buildings, is it right? The land the land and buildings were revalued on 1st October 80 million. Is it? The land and buildings were revalued with 80 million, attributed to 200 million to the building. Definitely, is it? 200 million to the with 80 million and to land, 80 million to land and 200 million to building. Okay, two things are there. What is the 80 million to land? Okay, 80 million to land, and whereas 200 million to the building. At that date, the estimated remaining life was 25 years. A further reevaluation is done, then the amount is going to be 85 million to the land and 180 million to the buildings. Okay, the remaining estimated value of the building is 20 years. Fine. Land is infinite life. Okay, plant is depreciated at 20%. 20%. Is it right? With the time apportioned where appropriate. On 1st April, they have purchased a new plant of 45 million, and in addition, this plant cost 5 million to install and commission. You have to add it. Is it right? Installation cost has to be added to the new plant wherever you are doing the telecommunication license. So fine, they are talking. See, this is with respect to what? This is with respect to land and buildings. Fine. This is with land and buildings. This is with respect to what? This is with respect to plant. This is with respect to license. Land, buildings. Okay, revaluation. Is it right? Revaluation. 80 million to the land, 200 million to the building. Okay, at that date, the remaining life of the building is how much? Life is how much? The remaining life of building is how much? 25. A further revaluation is not needed until October 1st, 2008. Is that this is happening on when? This is happening on 1/1/2003. Is it right? 1/1/10/2008. They have revalued the building, was valued. Okay, they have on 1/10 they have revalued. Is it right? There is a revaluation. 1 minute. How much is the revaluation? On a further revaluation is not needed until October 1st, when the land and buildings were valued at how much? 85 and 180. This is the land and this is the buildings. The remaining life of the building is how much? The remaining life of the building is how many? 20 years. Is it right? What they are asking, what is the carrying amount? Okay, what is the carrying amount of the land? Is it right? What is the carrying amount of the land and buildings? 2000. Here's the calculator. Fine. Okay. Now, what is the see what they have said? What they have said on October 1st. October 1st. Is it right? October 1st. October 1st they have revalued. Is it right? And when they are talking about, they are talking in terms of 30th September. 1 year. Okay. 1 year is over. 1 year over. Is that land? Land value will remain same on whenever there is revalued. Is it right? When they are revalued, what is the value of the land? The value of the land will be how much? 85 million. Buildings are there. Is it right? Buildings are there. How much is the building? Building value is revaluation value. Building value is how much? 180. Is it right? Building value is how much? 180. Is it? Minus depreciation. Is it right? 180 times 1 by 20. Okay, 1 year. For 1 year. The life is how many years? The life is 20 years. 1 year has been passed. Is it right? From 1st October 2008 to 30th September 2009. Is it right? 1. How much is there? 180 into, it comes to how much? 9. Okay. It comes to how much? 9. 171. 171. 6. 5. 256. Fine. 256. Plant is depreciated. What they are asking us, second one, what is the depreciation charge on the plant for the year ending? What is the depreciation charge? Plant is depreciated 20% on cost with time apportionment with appropriate. On 31st April, a new plant was 45 million was acquired. In addition to the plant cost 5. In addition, this plant cost 5 million to install. Fine. We have to calculate simple depreciation. Is it right? Simple depreciation. What is the plant is depreciated on cost? Is it right? What is the cost? Cost is how much? Cost is 150. Is it right? Cost is how much? Cost is 150. Okay. Cost is how much? Cost is 150. Fine. That's very simple. Is it right? What is the rate of percentage? 20%. Is it right? Nothing is there. Is it right? Nothing is there. Old plant. Is it right? Old plant. How much old plant? Old plant is 150 into 0.2. It comes to how much? It comes to 30 million. Fine. New plant. Is it right? New plant. How much is there? I'm just writing value is how much? Value is 45 plus installation is how much? Installation is 5. Total will become 50. Is it right? Total will become 50. What is the percentage of for the new plant? Yes. Is it right? See the things. New plant, is it right? New plant. When they have purchased new plant? April 2009, is it right? April, you put like this. See, very simple, is it? New plant, is it right? New plant, is it right? New plant from 1 April, is it right? To 30th September, is it right? 2009. For how many months? 6 months. Is it right? For how many months? 6 months. Is it right? Now, 50 into how many years are there? There's nothing is there, is it? 50 into 10, 50 into 20% into 6 by 12. It comes to how much? 5. Is that? Total will come how much? 35. Any doubt?
Can you explain it again, please?
Old plant for 1 full year. Okay? Old plant is for how much? For full year. Is it? Old plant is for full year. New plant, when they have purchased new plant, they have purchased new plant on when? 1/4. We are preparing on when? 30th September. Is it right? How many months we have to take? 6 months. Depreciation for how many months? 6 months. Okay? That's what we have done. New plant value is how much? 45. Installation cost is how much? 5. Total is how much? 50. What is the percentage? Percentage is 20%. Is it right? Percentage is how much? 20%. But here how many months? Only 6 months, not full year. Is it right? 6 by 12. 50 into 20% into 6 by 12, it comes to 5. Total 35. Is it clear? See, this is what new plant is only for. This is only for 6 months. Because it purchased when? You have purchased in April. You are preparing it for September. Is it? This has been purchased. Is it? You purchased in the month of April. You are preparing when? September. From April to September, April, May, June, July, August, September, 6 months. Is that right? You are preparing for 6 months. Are you clear about this? Sometime I have to listen no also, okay? Alhamdulillah, you are understanding, that's fine. How are you, Rizwan? Got it? Is it? But I want to know that if you are not clear, you can ask me anytime, okay? Having revalued the plant or property of Advent, it is required to make certain disclosure in respect of revaluation. Identify whether the following disclosures are not required in respect of revaluation. The effective date of revaluation, is it right? The effective date of revaluation is required, okay? Without effective date, how we can do the calculations? No. Professional qualification of the valuer. From an audit point of view, it is required. Okay. From accounting point of view, no. Okay. From audit point of view, is it? From audit point of view is required. But from accounting point of view, nothing. Fine. The basis used to revalue the assets, exactly we need. Okay. Without this basis, we cannot work. Okay. The carrying amount of asset, if no valuation has taken place, yes, carrying amount is there. If no valuation is there, carrying amount is there. Is it right? If there is nothing is there, then carrying amount is part of the life. Okay. Carrying amount is the part of the life. Means what? The effective date of revaluation is required. Is it right? It is not required. Is it right? I'll put the things. This is required. This is not required. This is required. This is required. Fine. Next. What is the amount of impairment loss on the license? It is with respect to what? It is with respect to point number C. The telecommunication license was bought from the government 1st October. 10-year life. It is amortized over straight line basis. In September 2009, means after 2 years. Is it right? Yes, after 2 years, a review of the sales of products have been related to the license showed them to be very disappointing. As a result of this review, the estimate recoverable amount of the license after 2 years is only 100 million. How much they have bought it? They have paid how much? Is it right? Carrying amount is how much? Carrying amount is 270. Okay. Carrying amount how much is 270. It is amortized on a straight line basis. Is it right? It is amortized on straight line basis. Means how much they have deducted? 30. Amortization will also be 30. Is it right? Next. What is the recoverable amount? The recoverable amount is 100. Easy. Very simple. Is it right? Very easy. It's not difficult. Is it right? No. Very easy. Is it? Balance. Balance as on 1/10/2008. How much is the balance on how much? 270. Fine. Minus. Is it right? Minus amortization. Is it right? Minus what they have said. What they have said. Amortization. Okay. Amortization. How much? To 10-year life. It is amortization on straight line basis. Is it right? Amortization how much? Less amortization. Straight line means every year it will be same. Is it right? Amortization. Is it right? How much? 30. Is it amortization means? Amortization means on a what they said? Amortization on a straight line basis. Is it right? How much? 30. Is it? How much you will get? 240. Is it right? How much you get? 240. Next. Recoverable amount, carrying amount, recoverable amount is how much? This is what? This is the carrying amount. Is it right? This is the carrying amount. Recoverable amount is how much? Recoverable amount is how much? 100. Is it right? Recoverable amount is how much? 100. Is it right? What is difference is how much? 140. 140 is what? 140 is impairment loss. Are you clear about this? Good. Fine. Advance license is not now carried at a recoverable amount. Complete the statement using the options provided. Recoverable amount of an asset is the higher of what? Tell me. Carrying amount, see, is it right? The recoverable amount of an asset is higher of what? Fair value less cost of disposal or value in use. Is it fine? We will do this, okay? Can we do this and stop? You tell me. Yes, Rizwan. Good. Twelve, 11, 2, 22. Is it right? Good. Cesteria company is preparing its financial statements for the year ended 31st December 2007 and has a number of issues to deal with regarding non-current. Cesteria suffered an impairment loss. How much they have suffered impairment loss? 90,000. Okay. 90 to one of its cash generated units. The carrying amount of the asset of the assets in the cash generated units prior to adjustment is how much? Now what happens? See the things. Get my point? What will happen? That's very important. Is that impairment? Is that straight away non-current assets will not change. Okay, non-current assets will not get affected. Understand point? 100%. Is it right? Non-current assets. Goodwill will go straight away minus. Patents will go straight away minus. Is it right? Minus. Now, Is it right? Goodwill is going, patents will go. Land and buildings. Is it right? How much? See, how much is there? How much is there? 50, 90. Is it right? 90. Land and buildings 150. Land and buildings is how much? 150. Fine. 150. What is the value of land? 100. And what is the balance? Balance is 30. 100 divided by 150 into 30. Good. You know how we got it? You should recover. You should have immediately. You should have recovered. Is it right? These two values are how much? These two values are 150. Okay. We have to allocate. How much is there? These two is 60. Is it right? Total impairment is how much? Total impairment is how much? Total impairment is 190. Is it right? Now, less goodwill. Is it right? Less goodwill how much? 50. Less patents. Is it right? Less patents is how much? 10. How much is balance? 30. Is that land? Is it right? Land. How much is the value of the land? Land value is 100. Total land and buildings is how much? 150 into 30. It comes to how much? It comes to 20. Next, buildings. Buildings. How much is the buildings? 50. Total value is 150. Impairment leftover is how much? 10. Is that 20 plus 10? 30. Fifty fine 50 what is the post impairment plant and machinery. Okay, post impairment of plant and machinery. Good. They are asking about the plant and machinery. I didn't saw that. Is that they are asking about what? Plant and machinery. Is that? No, 1 minute. Still it is not complete. It comes to how much? 20. It comes to how much? 10. Total is come to how much? 90. Okay. Now plant and machinery how much? Plant and machinery is how much? 50 minus 10. It comes to how much? 40. Is that? It comes to how much? 40 thousands. Okay. 40,000. Are you clear about this? Any doubt? First lecture, we have to recover. Is it right? Good. Alhamdulillah, we are doing revision for this. Any doubt? Tell me. Can I go to the next one? Fine. The finance director has been asked to report to the board on the two reasons for the impairment review of the cash generated unit. Which two of the following would be an internal indicator? Is that means external indicator and internal indicator? Is that external indicator and internal indicator? We want to know internal. Market value of the asset, it is external, okay? It is external. Adverse, is that? It is external. Adverse impact changes to the use of asset when it is internal. Is it right? It is internal. Asset is fully depreciated. It is internal. No, 1 minute. Asset is fully depreciated. Fully depreciated, it is not going to be considered as such. Is it right? If it is fully, is it right? It is, when it is fully depreciated, the asset is irrelevant. Is it right? The asset is irrelevant. There is no value of the asset. Why we will say indicator? Is right? This is the operating performance of the asset has declined. This is internal. See, this happens, okay? Immediately we have to think, okay? Then it makes some difference, okay? What is the carrying amount of goodwill in the two following the impairment review? Select your answer from the well done one. Is it what is 2? Yes. Is it right? They are talking about this. Is it right? They are talking about this. What is the goodwill? Is it right? Fine. During the year 31st December, sister acquired Domino for how much? 10 million. Is that how much they have acquired? They acquired it for 10 million. Fine. Acquisition price. Acquisition price. How much? Acquisition price is 10 million. Okay. Its tangible assets are how much? Its tangible assets are how much? Tangible assets are 7 million. Okay. And goodwill is how much? Goodwill is 3 million. Okay. Goodwill is 3 million. Fine. Our assets are carrying an amount. Amount is how much? Carrying amount. Is right? Carrying amount of assets. Is it how much? It is 2.5. Is it right? 2.5. And subsequently destroyed. Sorry. Sister has carried out an impairment review of the established that Dominico company could be sold for how much? Okay, there is sold value of company. Is it right? Can be sold. Is it right? How much? 6 million. Value in use, how much? Value in use is how much? 5.5 million. $5.5 million. Recoverable amount is how much? 6 million is nothing but recoverable amount. Okay, 6 million is not. This is nothing but this is a recoverable amount. Is it right? Recoverable. Where I have to write? I have no space there. Fine. Now, is it? This is what? This is the recoverable amount. Okay, recoverable amount is how much? 7 million. Fine. Recoverable amount is how much? 6 million, sorry. Is there recoverable amount is 6 million. Acquisition price is how much? 10 million. Fine. Now impairment is impairment is impairment is impairment is impairment is acquisition price. Acquisition price is how much? Acquisition is 10 million. Is it right? Is it right? Recoverable amount is how much? Recoverable amount is how much? Recoverable amount is 6 million. Is it right? Recoverable amount is how much? 6 million. Impairment loss. Is it right? Impairment loss. Is it right? Impairment loss is how much? 4 million. Fine. Impairment loss is how much? 4 million. Is it what they are asking us? What they are asking us? What they are asking us? What they ask you? What is the carrying amount of goodwill following the impairment review? Is it following the how much impairment loss? 4 million. Is it right? Now, carrying amount is how much? What is the carrying amount? They are asking what is the carrying amount of the goodwill. Is it right? Carrying amount of the goodwill is 2.5 million. Okay. After impairment. Is it at 1 minute? It's easy. Is that 1 minute? Is it right? Goodwill is how much? Goodwill is how much? Goodwill is 3 million. Is it right? They are asking about the goodwill. Okay. They are asking about what? What is the carrying amount of the goodwill? Okay. Following the impairment review. Is it right? What is the carrying amount of goodwill? Less impairment loss. Is it right? Less impairment loss. Impairment loss is how much? Mm-hmm. 1 minute. Carrying amount, goodwill is how much? Fine. Okay. Goodwill is how much? Goodwill is how much? 1 minute. Goodwill is how much? 3 million. Okay. Now, now, is it 1 minute? Now, how many? See now what happens? See 1 minute. See assets. See it has been given. Is it assets of a carrying amount of 2.5 million was subsequently destroyed. Is it right? Subsequently destroyed. How much they have destroyed? 2.5 million. Is it right? 2.5 million has been subsequently destroyed. Is it? Impairment is how much? Impairment is 4 million. Is it right? Impairment is how much? 4 million. Is it right? Impairment is how much? 4 million. See, we have to make sure. Impairment is how much? I will write with another ink. Okay? Impairment is how much? See, what impairment is how much? Impairment loss is how much? Impairment loss is 4 million. Fine. Now, in this, assets destroyed. Is it right? Assets destroyed is how much? 2.5 million. Okay? 2.5 million. Is it right? 1.5 million. Is it right? 1.5 million is the net impairment loss. Is it right? It is how much? Net impairment loss. How much is there? Net impairment loss is 1.5 million. Fine. This 1.5 million has to be, this 1.5 million has to be, is it right? 1.5 million, 1.5 million, is it? This is the net impairment loss, is it right? Net impairment loss. How much is the net impairment loss? 1.5, is it right? 1.5, little bit, is it? Not difficult, but we have to be very cautious, is it right? We have to be very cautious. Fine. Is it 1.5 million? Is it right? How much is there? $1.5 million. Is it right? This is the, which is the carrying amount of goodwill in the following. This is what? This is the carrying amount of goodwill. What is the answer? Answer is 1. Is it? Carrying amount is how much? 1 part. Are you clear about this? Just go through it, okay? Just one minute, just review it step by step. Then you will understand how we have got it. Then you tell me yes or no. You find anywhere any small doubt, how you didn't understand any number, please tell me. Total impairment loss is 4 million, is it right? Out of this, loss, the assets has been destroyed is 2.5 million. Net impairment loss is 1.5. That 1.5 we have to deduct it from the goodwill. Is it okay? Which use the drag and drop option below. Select the double entry required to record the revaluation. How much is the revaluation? That's very first we have to know what is the revaluation. Is it right? Point number 3. Is it? Point number 3. The freehold property was 150-year-old life and accumulated depreciation of 20,000. The assets is revalued is how much? 130. Simple. Is it right? Simple. It's how much? Is it right? Revaluation is how much? 130. Is it right? 30. What is the original cost is how much? Original cost is 100. Is it right? Minus depreciation is how much? 20,000. Is it right? It comes to how much? 80,000. Is it right? How much is there? 50,000. Is it? This 50,000 is nothing but revaluation surplus. This is nothing but revaluation surplus. Revaluation surplus is credit. Is it right? Revaluation surplus is what? Revaluation surplus is credit. How much credit? 50,000. Depreciation is how much? Accumulated depreciation is how much? Accumulated depreciation is 20,000. Is it? Property at cost is how much? Property at cost is how much? 30,000. Is it right? How much is it? It is 100,000, 100,000, 20,000. Is it right? 80,000. Is it right? 80,000. Revaluation is how much? Revaluation is 130,000. Is it right? Difference is how much? Difference is, I'm writing again, okay? Difference is how much? 50,000. Accumulated depreciation is how much? 20,000. The balance is property at cost. Okay? What will be the depreciation charge relating to the asset in 3 for the year ended 31st? Is it right? See, when we have done on revaluation, the depreciation should be calculated on. See, depreciation should be calculated on revaluation amount. Is it always on revaluation amount? Okay, always. How much is the revaluation amount? 130,000. Okay, 130,000. How many? What is the life of the asset? Life of the asset is how much? Life of the asset is how much? 50 years. Is it right? Life of a property originally costing 10,000 with 50 years. Life has accumulated depreciation of 20,000. Accumulated depreciation of 20,000. The asset is revalued at 31st December 2007. Is it right? 31st December 2007. How you calculate remaining life? Any idea? How we calculate remaining life? Now, how much you have calculated depreciation? 20, is it right? 20 divided by 100. It comes to how much? Uh, 100. How much? 5 years has been elapsed. 5 years. One minute. Depreciation, how much? How is the remaining life we have to calculate? They have calculated depreciation of 20,000. Is it right? 20,000. 20,000. 20,000. 20,000 years. If you take 50 years, is it right? 100,000 divided by 50. Okay, yeah. 100,000. Easy, no problem. Depreciation per year. Is it right? Depreciation per year. 100,000 divided by 50 years. Is it right? How much? 2,000. Okay. Is that and for 10 years, depreciation is how much? 2,000 into 10, 20,000. Is it right? This has been given. Is it right? Remaining years how much? Remaining years is how much? Remaining years is 50 years minus 10 years. It comes to 40 years. Is it? Now, depreciation is how much? Divided by 40 years. This is the revaluation amount. Is it right? This is the revaluation amount. How much you will get? 130,000 divided by 40. It comes to how much? It comes to 3,250. Where is that?